Hello and welcome. This lecture video will be covering Chapter 11, Current Liabilities. And more specifically, in this specific lecture video, we'll be talking about giving an overview of current liabilities, talking about the characteristics of liabilities, talking about the ideas of uncertainty in liabilities, and also doing a few quick check problems, okay? So let's define a liability. And so this is a good definition of a liability. So it says a probable future payment of assets or services that a company, an organization more broadly, is presently obligated to make as a result of past transactions or events. So we have three factors. If we were to parse this definition into three different factors, here they are. First, there's a past transaction. Okay? And then because of that past transaction, there's a present obligation. And then that present obligation that we have is for future payments of assets or services, okay? We have to have all three factors for a liability to be reported. So let's think about this in terms of the concept of my mortgage. That's a good way to put it into context, okay? So I bought my house back in 2012. Was there a past transaction? Yes, I bought the house. I signed the paperwork for the mortgage, okay, to finance the purchase of my house. Now, because I bought that house and because I signed the paperwork, there's a present obligation. I have an obligation to make monthly mortgage payments on my house, okay? Now, my future payment of assets or services, the specific asset that I have to use to make my monthly mortgage payment is cash, okay? But then it says over here, or services. So a liability doesn't have to be that you owe somebody cash, that you owe another company cash. It could be that you owe them a service. So let's look at that as an example. Let's say that we get paid, we're a company and we get paid up front. Remember, we get paid up front for future management services over the next 2 years. So we get paid up front to provide management services, almost like prepaid management services over the next 2 years. Okay? So we get paid up front. Because we got paid up front and we signed the contract that says to our client, we are going to give you management services over the next 2 years, we have an obligation. Now, our future payment is not in cash, it's not in assets, it's in management services. So we owe management services to our clients over the next 2 years. We don't owe them cash, we owe them a service. Okay? And remember what we talked about that back in some earlier chapters. We said that's unearned revenue. Okay? So that's what that is. We have that current liability called unearned revenue. Now I say right over here, if one factor is not present, the liability is not reported. So for example, we say most companies expect to pay wages to their employees, right? But this is not a liability because no past event such as the employee work has resulted in a present obligation. Rather, these liabilities arise when the employees perform their work and earn the wages. So let me give you an example of this. So I'm scheduled to teach Accounting 101, this class, in fall 2020. Okay? Mary Washington does not owe me money, does not have a salaries payable to me up on their balance sheet for fall 2020. Why? I haven't started teaching the classes yet. Well, this is summer 2020. I have not started teaching the classes yet in fall 2020. Now, once I start teaching the classes, I perform my work and then I've earned those wages. I've earned that salary. Okay? So until I start performing the work, Mary Washington doesn't have a liability. But once I start performing the work, then they have a liability. Okay? So let's talk about the difference. So again, with Chapter 11, we're talking about current liabilities. Okay? Focusing on current liabilities. In Chapter 14, which we'll talk about in Accounting 102, we talk about long-term liabilities. So let's talk about those differences between current and long-term liabilities again. So remember, current liabilities are those obligations due within 1 year or the operating cycle, whichever is longer. So for example, the current liabilities that we'll be talking about in this chapter, wages payable, accounts payable, short-term notes payable, taxes payable, unearned revenues are examples of short-term liabilities. So think 1 year or the operating cycle, whichever is longer. Long-term liabilities are obligations that we don't expect to pay within 1 year, longer than the operating cycle. So examples would be long-term notes payable and then also bonds payable. Now, why is it important to classify our liabilities correctly? Remember your friend, the classified balance sheet. Remember we talked about that back in chapter 4, the classified balance sheet, where we said we need to break out our assets into current assets and then non-current assets, and then also our liabilities into current liabilities and non-current liabilities. And why do we need to do that? Well, it makes it easier to calculate financial ratios. So remember, for example, we talked about back in chapter 4, we talked about the current ratio. And we define the current ratio as just current assets divided by current liabilities. All right? If you fail to classify your liabilities correctly, and then you show something that is truly a long-term liability, but you classify it as a current liability, mistakenly classify it as a current liability on the classified balance sheet, someone who is trying to then calculate the current ratio is going to be incorrect. The denominator, current liabilities, will be too large, right? Because you misclassified a long-term as current. So then that throws off the current ratio and other ratios, okay? So it's important to classify these right so that investors who are using these financial statements to make decisions can then calculate ratios correctly and also interpret the financial statements correctly, okay? All right? So it can distort our financial statement analysis. In that example I was saying is our current ratio, all right? So we can have some uncertainty in liabilities. So what I'm trying to say here, let me clarify this with the uncertainty in liabilities, is that we can have some uncertainty with regard to our liabilities. But we can still have a liability even though we have some uncertainty with respect to whom to pay, when to pay, and how much to pay. So even though there's a little bit of ambiguity with those questions, whom do we pay, when do we pay, and how much do we pay, even though there's uncertainty, we can still have a liability. And let me explain that a little bit more. Okay, so let's look at the first question, whom to pay. There can be uncertainty in whom to pay. Liabilities can involve uncertainty in whom to pay, but you can still have a liability. So if we issue a note payable, for example, that company could sell the note payable to another company. And I'll give you an example. The same thing has happened with my mortgage. The company that I initially took out my mortgage with, they have sold my mortgage to another company. And so then I just write my mortgage check to the new company. Does that mean that I don't have a liability? No, I still have a liability. It's just that whom do I pay could change. In 5 years, that the company that I pay my mortgage to right now, they could sell my mortgage to another company. Then I just pay the new company. So there can be uncertainty because in 5 years from now, I don't know who I'm going to pay my mortgage to. I don't know. But I still have a mortgage to pay. I still have a liability. So that doesn't matter. Okay. So even though there's uncertainty in whom to pay, I still have that liability because there was a past transaction. I bought the house, a present obligation. I have to make my mortgage payments, and then a future payment of assets or services, in this case, my assets of cash. Okay. So I have those three factors. So I have a liability. I owe someone money because of a past transaction. I have a liability. I just don't know who I'm going to be making my mortgage payment to in the future because I can sell my mortgage. Okay? All right. So let's look at the next question. When to pay. There can be uncertainty about when to pay. So I'm saying that right over here. For example, a law firm may accept legal fees in advance from a client who plans on using the firm's services in the future. So this is the situation, right, that I was talking about. Law firm gets paid up front. What do we call that? That's unearned revenue, remember? Now, so the law firm gets paid up front by their clients, and the clients say, over the next 2 years, you're going to protect us. You're going to give us legal services in case we get into hot water, in case we get into trouble, legal trouble. You've agreed to provide us services over the next 2 years. Fine. Well, we're the law firm, right? So we debit cash, we credit unearned revenue. That's what we have. Unearned revenue, it's a liability. Here's the thing. Do we know, let's say we got paid for 2 years up front, 2 years of prepaid legal services, right? So got paid, we have an obligation to provide 2 years of legal services to our client. All right. Do we know if our client is going to need help in year 1 or year 2 or August of year 1 in September of year 2? No, I don't know. Depends upon when our client does something stupid and gets in legal trouble, right? That's when we would have to fulfill that liability. So there's some uncertainty on when we're going to have to provide those legal services. It depends upon when our client needs our help. Okay? Does that mean that the law firm would not show this as unearned revenue? No, they still have that liability, unearned revenue. It's just that we don't know when the client's going to need help. Year 1 or year 2? I don't know. Depends on when they do something stupid and need our help. Okay? So there's some uncertainty on when to pay. And then finally, there can be uncertainty about how much to pay. So for example, a company using electrical power is billed only after the meter has been read. Okay? The cost is incurred and the liability is created before that bill is received. Okay? So we can have some uncertainty as well regarding how much to pay. All right, so let's look at these quick check problems here that are on pages 248 and 249, okay? So why don't you pause the lecture video and do this one, number 1, number 2, number 50 on page 248, and then number 49 at the top of page 249, okay? Pause the lecture video and then do those problems, and then we'll come back and check it. Thanks. Okay, so let's see how you do. Number 1, a liability is a probable future payment of assets or services that a company is presently obligated to make. Yeah, that's the definition of a liability, straight out of the notes, so that's true. Obligations not due within 1 year of the company's operating cycle, whichever is longer or current. No, those are long-term. Okay, so longer than a year. Okay, it's long-term. Liabilities must be certain. No, we just talked about uncertainty. Must be for a specific amount. No, because remember we said that there can be uncertainty on how much to pay. Must always have a definite date. Nope, we talked about uncertainty there. And then it doesn't always have to involve an outflow of cash. Remember, it can be services, future payment of services. So B is the right answer. Number 49 right over here. All of the following statements regarding uncertainty and liabilities are true except a liability can involve uncertainty in whom to pay. Yep, that's true. A company can create a known amount when issuing a note, even though the holder of the note may not be known until the maturity date. Yes, that is true. That's the exact same situation. That's the exact situation that I was talking about with my mortgage. Okay. Company can have an obligation of a known amount, but not know when it must be paid. Yep, that's the idea of that legal services we got paid up front, and now we have unearned revenue. We don't know when our client is going to need our help. Okay. E, a company can be aware but not know how much will be required to settle it. Yes, that is also true. So the one that is not true, because remember we're talking about except, is D. The company only records when it knows exactly whom to pay, when to pay, and how much to pay. We said that there can be uncertainty with regard to those questions. So D is the one that doesn't belong. All right. Thanks so much. The next lecture video will pick up here on known liabilities. Okay.